Okay. Welcome back, everyone. This is section 4 of our Back to the Basics of Multifamily Investing series. Please keep in mind this is for educational purposes only, and feel free to refer back to our disclaimer from our first video or see below. In this video, we will go over our company's investment strategy. Let's get started. Here at NuRoots Investment Group, we are experienced in multifamily syndications. We have invested in over 400 units across the U.S., and our strategic advisor, Vinny, and his team have also syndicated over $300 million in assets and have a track record of double-digit gains per year for our investments. Now, this is our secret sauce. First, we're going to invest in emerging markets where economic growth potential is high and stable. We are going to reposition through implementing systems that make it more efficient and increase the quality of life for the residents. We're going to force appreciation through renovations and or expense reduction. We're going to have consistent cash flow once the property is repositioned. We're going to basically buy, hold, and sell when rents peak. We're going to also invest in C+ properties to B assets in the B to A neighborhoods. So this is our process. It is a 5-step process. We're first going to locate those value-add properties. We will then do this thorough due diligence, and then we'll negotiate contract and financing with our partners. Then we're going to have our networks manage the asset. We're going to improve that net operating income and distribute cash flow. And then when the time is right, we're going to liquidate that property. So first in that process, find the property, specifically those that we can actually add value to. We analyze the market first. Since real estate prices and rents are very local, we look for emerging markets where economy and rent growth potential is high. And we create networks within the real estate space and get off-market deals, or maybe you've heard pocket listings. We analyze these properties looking for signs of potential value adds. And these are some of the value add factors we look for. We look for deferred maintenance. We look for those landlords who are motivated to sell, maybe those solo players. We do look for properties who may look like they've had bad management before. We look for properties who we can add value adds like resident services, so like laundry, and also those lower market rents, as well as resident utility buybacks. Now, when looking at the market, we need to determine the phase that is actually in. Here's all the different types of phases: buyer's market 1, 2, seller's market 1, and seller's market 2. We purchase in the markets between buyer's market 2 and seller's market 1, basically in apartments that are in the emerging market. We then sell the asset between seller's market 1 and seller's market 2. There are 4 classes of property: A, B, C, D. Going from A, luxury properties rated highest in quality and amenities, so think high rises, think gyms, new constructions, to D, properties that are high in likely high crime areas. We look for property in C and D classes where appreciation potential is the highest and cash flow is good, because as you can see, these properties are likely in a better location so that they actually do have value add that we can put to it. Now, another factor we look at in determining the area for these value add properties is migration. Now, I don't want you to look into all of these. We will share this with you later. But migration, population data, and the rate of renters in those areas, this is an example of that. In the counties of the areas that we are currently focusing on, most of that population change is net positive, and it's especially good in this Clark County that you see here, that is actually where Vancouver, Washington is. Now, another data point that we consider is the trend in the average cost of rent in that area as compared to the national average. In this example, where you see the national average is beginning to plateau average rent prices in Vancouver, Washington is staying strong with a slight increase in the face of the pandemic. Another data point we look at is what renter percentage looks like as compared to home ownership. Now, while there are quite a few strategies we reviewed already on finding value add properties, there are still a number of additional methods that we employ to make sure we find properties where it makes the most sense. Step 2, we find a property that we might be interested in, and before we look to give a letter of intent, we would carry out the number crunching. This is all part of that financial due diligence to see if the deal is going to be good, in which we will calculate conservative projections. We would validate all of their operation strategy and cadence. We'd request their profit and loss statement, and would also get their past and current rent rolls and compare that to current market prices. From there, we would calculate conservative income, so everything conservatives here, for any cash-on-cash returns, cash flow income, and net operating income. Finally, we would then include clauses that would be favorable to the deal on our letter of intent. Another part of due diligence is property inspection. First, to know that commercial real estate rules are different than SFR. We do complete physical inspection. Every unit is inspected with a contractor, and all of the major systems are inspected. We also investigate any easements. Then we get to step 3. We negotiate contract and financing. We know what the most important terms are, and we use creative ways to ensure we get the best terms on our agreement. In order to obtain the best financing, we network with brokers and banks. We also educate ourselves on the loan products available for the type of property we invest in. In terms of what we take care of versus what our investors would bring, we basically take care of the majority of the asset acquisition and management. Our investors will bring in and provide the necessary capital for our acquisitions and for repositioning the properties. Step 4. Once the asset is acquired, we will manage the asset to reposition it for maximum profit. So we're going to do the following. We're going to obtain property management through our network. We're going to create a business plan to add and create value. We're going to manage the day-by-day operations. We're going to also manage the cash flow distributions for our investors. On that, we're also going to make sure we issue quarterly financial reports. We also will hold regular webinar updates on the project and the asset itself. We will perform property inspections regularly, and we're going to manage our team that will carry out the value add components of our plan. Then we're going to obtain refinancing if the numbers make sense. Then, last but not least, once we've delivered all of the value add after a holding period of likely between 3 to 7 years, depending on the deal, comes step 6. We're going to liquidate the property. We're going to handle everything for the sale of the property, including preparing marketing materials, contacting sales brokers in our network of trusted agents, selecting a buyer with good qualifications and capable of closing. We're going to negotiate the best terms and prices. We're going to then disperse equity after sale or reinvest in another property via 1031 exchange for higher value assets. And that covers it. Thanks for listening to our strategy as a syndicator for commercial multifamily investments. See you on our next video in the series where we're going to review one of our own investment properties. Now, if you'd like to contact us now, find our contact info below. Thank you.